Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today. Is the budget 2024 only a bond budget, or do equities benefit meaningfully from this as well? We'll ask our guests that. Will the Indian equity market sustain their outperformance over other emerging markets? And are there pockets of value in small caps still existing despite the rally that we've seen? Well, let's pose all of those questions to our guest today. Manish Gunwani of Bandhan AMC joins us on the show. Manish, great having you. Thanks for taking the time out and being with us. Hope all is well. I believe it's the first time that we're talking to you on NDTV Profit, so welcome.
Thanks, Niraj. Thanks for having me.
Pleasure is entirely ours. Manish, I was reading an article that you had written, or an interview that you had written about, wherein you believed at the start of the year that Indian equities would be that point of outperformance, or that oasis of growth, if you will, in an otherwise not so strong global market scenario. Does the budget do anything to reinforce that view, Manish?
Yeah, it does, because while it may look like a very placid budget in one sense, because it's a vote on account, I think it's a pretty brave budget in the sense that obviously there is no populist, or revenue expenditure growth is very minimal, which basically keeps a lid on inflation. So from a macro stability perspective, and more directly maybe from a currency perspective, because I think a lot of attraction for India is as much from currency as from stock market. See, a lot of us in the stock market, obviously we are bottom-up people. But I think the interesting point, or the interesting trend that is developing is that the dynamic of India's macro stability in terms of current account deficit and inflation, I think that is probably understated to my mind, in the sense that for a foreign asset allocator, if you look at India, it's a currency where the current account dynamics is seeing a generational shift. It's once in a 30-40 year kind of shift, where an economy which is typically 2 to 3% current account is probably moving to 0%, versus US, which is still 2 to 3%. So in that sense, the currency dynamics, I think, will attract a lot of foreign capital. And the budget, to the point that, as I said, keeping inflation under control, keeping interest rates benign, because we've seen bond yields fall after the budget. All that means that the dynamic of foreign asset allocators looking at India, probably more from a fixed income perspective, it probably looks attractive initially. But even for equities, if foreign capital is attracted, then obviously the growth prospects go up. So I'm quite positive that in the medium term, India will continue to outperform emerging markets, especially given this developments what are happening on the currency side.
Okay. You surely, I mean, I'm just trying to understand, is your belief too that this, I mean, from an investor's hat, wearing an investor's hat, always keeping an eye out for that 4% average depreciation in the rupee while factoring in the kind of returns that you're doing, especially foreign portfolio manager. I know you manage domestic portfolios. I'm just trying to ask you to wear the global investor's hat. Do you think that's a big change?
Yeah, I think personally, I'll not be surprised if rupee is flat for 2-3 years, because when you look at line item versus US, whether it is current account deficit, real rates, I think India is actually better in a lot of respects. Government debt to GDP, for example. So the simple point is, for example, that if you take our 10-year yield minus inflation, we're probably about 200 bips real rate, whereas in US, it's almost zero at this point of time. So on various metrics, I think that India is screening very, very strongly for foreign capital to be looking at India in a very, very positive way. So, yeah, to the point you asked, historically, Indian currency has depreciated 3.5% to 4% last 30 years. Can it next 5 years do much better than that? I think so.
Okay. And so, Manish, the other aspect is you saying that the Indian markets will be that bright spot, quote unquote. I'm not verbatim quoting you, but something like that. Now, I have a two-part question here. One is this: as somebody who is managing large pools of money, are you comfortable putting in money to work at these valuations? And two, is this whole conversation around Indian valuations overblown? Because at any given point of time, in any of the quarters, in any of the last few years, say for one or two, you could have had the same question asked to you that Indian markets are overvalued, should one invest in them or no?
Yeah, so look, when I'm talking so positively on the Indian currency, don't get me wrong, I'm not so bullish on global growth or as a consequence of global growth, even India growth. So, for example, I don't think we will have a 2002 to 2008 kind of cycle where global growth was strong. China, India were growing 9-10%. Commodities had a super cycle. I'm not of the view that we're going to get that kind of cycle either globally or in India. So I do think that structurally, very big parts of global GDP like Europe, Japan, China, and maybe even US on a cyclical basis will slow down, or they're already slow. We've seen China and Europe obviously struggle even last year. So let me be clear that I'm not so positive on overall GDP growth, but I do think that both on a relative basis and the fact that our net service exports have become much bigger than our energy imports, which is the big delta in current account dynamics. Obviously, we will look very, very attractive for foreign capital. Does it mean that we will get very strong EPS growth on an overall basis? I don't think so. Because as I said, when global growth is low, India also can't, go back to 9-10% growth, I think, when global growth is deflationary and soft. So in that sense, I think we will have a very selective bull market because valuations obviously are expensive right across, which is why I think there are pockets of value more in the small cap space, I feel, which can do well. But to expect that we will have a very strong bull market like 2002 to 8, not something my base case is.
Did I hear Manish Gunwani tell me that there is more value in the small caps?
Niraj, so let me nuance it a bit. See, what I'm trying to say is that we are living in a world which is Japanified, right? I mean, every big region is looking more and more like Japan with high debt to GDP, very poor demographics, very, very low real rates, right? So there is a bit of a challenge on growth globally. And when that happens, the very, very large sectors or very large companies, I think, rely more on industry growth or global growth, right? I mean, whether you see banking, IT services, FMCG, they are a play on very broad-based growth. They can't be very narrow because these sectors or these companies, they are like 50 billion, 100 billion, 200 billion, very, very big company. Now, if you are having an environment where global growth is soft, India growth is somewhere between 6 to 7%, then I don't think there'll be big upgrades in large caps, right? Also, I think one big issue we are facing is that there is inequality of growth. Most of the world is having a K-shaped economy, in which case, again, if the pyramid doesn't broaden, then very large companies will struggle. So I think there are multiple challenges for very large companies, unless you have a very, very sharp tech mode or a non-linear business model, which the FANGs have, for example, right? Now, in that scenario, you will have to find companies which grow irrespective of the industry growth not being too great, which typically will obviously happen in small caps. Now, I know the small caps last year have been on a tear, so I'm not necessarily saying small cap index will do well because the small cap index has 250 or 400 companies. But can 40, 50 of those companies do better than Nifty 100? I do think so. And then it's our job to find those 40, 50, right?
Yeah, and viewers, I hope you understand the nuance that Manish Gunwani is trying to make. Please don't accept that statement that small caps as a bucket will do really well. As an index, it may not. In fact, out of whatever number of stocks, 75% may not do well. But a portfolio or a fund house can choose the best of the remaining 25 and still give extraordinary returns. I think that's the point to make. And therefore, within that landscape, it pays to try and hunt for winners, and which is what fund houses or fund managers can do well. So I think that's the point Manish Gunwani is probably trying to make. Manish, so therefore, let's try and give more nuance to this as well. Sorry, I'm picking on this point because it's an interesting one. Not too many people come out and are brave enough to say that, nahi, mujhe small caps mein teji dikhti hai. So here's my question to you. There are some pockets which are overvalued, both large cap, mid cap, small cap, the entire universe. What within this smaller universe, be it mid caps or be it small caps, do you find hints of value or hints of predictable earnings growth which will take care of the steep valuation, as the case may be?
So I think 2-3 segments which we've been bullish on is one is the power capex theme, the power equipment theme actually, because there is a big global synchronized capex which is happening towards renewables, transmission and distribution. So anything in the power equipment value chain, whether it is transformers, substations, wires, cables, windmill equipment, whatever, I think that is an interesting space to look at. The second is even in financials. I think a lot of the small cap financials, which are NBFCs or microfinance or AMCs, I think they are more interesting than large banks, because large banks, as I said, first of all, I don't expect credit growth to accelerate, so there's no big cycle there. Second is large banks are big in unsecured retail. They are very dependent on CASA, which is not growing. So the large banks have a lot of issues. The small financials, if you can choose, as I said, it's all about what you want to choose. But I think there is interesting plays in small cap financials. Real estate, again, is a sector where I think the small caps look more interesting than the large caps. There are a lot of building material or domestic cyclicals in, let's say, pipes or various kinds of segments where, again, small caps look better. I don't think there are any big large caps there, but basically small caps look better than mid caps also. So there are, I think, a host of areas where still it seems to make sense to be in small caps versus mid caps or large caps.
Wow. Okay, we'll try and probe some of these on the other side of this break. We'll also talk about the most obvious ones, the pain in banks and how it continues, because I heard Manish Gunwani say that the growth in some of the AMC or other financials, the non-lending financials, could be even better than the banking space. Should you bet on banks at all? Because we have limited capital. I think all of that coming up on the other side of this very quick break. Stay tuned to this very interesting conversation on Talking Point today. All right, back with talking point right here on NDTV Profit in conversation with Manish Gunwani of Bandhan AMC. One of the points that Manish made before the break was about how select pockets at the broader end of the spectrum might do better. And because the thesis is interesting, viewers, he used the term Japanified, if I'm not wrong. And in a world which is Japanified, high debt, maybe low growth, etc., larger companies align themselves to the growth rates of the world at large, maybe. And therefore, the growth rates out there might not be as impressive, whereas smaller companies might be able to do. So there's a nuance to the point that Manish Gunwani is making. Now, I will ask him about some of the specifics within there. We'll end with the obvious question on PSUs, I assure you that. Manish, I want to ask you about the non-lending financials. There seems to be a belief that the industry is, in some sense, consolidating on the broking side, on the AMC side. The top 5, top 10 are kind of holding fort and becoming larger. And at some point of time, it will start showing in the numbers. Maybe it's come in the brokerages, it'll come in the AMCs after a lull for the last 2-3 years. Just wanting to understand, what's the rationale of betting onto the capital marketplace, for example?
So definitely, I think for different reasons, consolidation seems to be happening. I think broking, on the retail broking side, actually, it's the most visible and acute, purely because there's a tech element, right? I mean, the tech platforms have taken massive market share from the traditional brokers. On the exchanges, we are seeing actually fragmentation in one sense, the smaller exchange getting a bit of market share. On AMCs, I think it's difficult to make out right now because some of the top AMCs have done very well in terms of equity performance. So we don't know if the market share is happening because of that. But yes, the slide in market share of top AMCs is definitely arrested. And more importantly, I think that the equity MTM growth obviously is helping earnings. So AMCs are reflexive plays. So as long as you believe the market is going to do well, they'll do well. I think because purely the mark to market itself will translate into earnings. So there is a lot of interesting things on the capital market. It tends to be a late stage play. So in the last stages of a bull market, capital market stocks tend to do well. I think in one sense, we are seeing that kind of behavior. But the point is that I think there is also a lot of capital in large banks, which is wanting to come out given the underperformance. And that's, I think, an important flow dynamic. And the point I was making was that in the expensive banks, I think you're seeing multiple challenges that 3 big challenges to my mind. One is a lot of them have exposure to unsecured retail, and we've seen both the regulator and anecdotal talk about credit quality worsening there. The second challenge is on the CASA side, where especially on the savings account, we're seeing multi-year low growth. And the third is that in various profit pools, let's say in credit cards, payments, distribution, platforms like Zero, Grow, UPI, for example, against credit cards. So there are a few profit pools of banking which are getting disrupted by tech as well. So within these 3 big challenges, I think that's the reason why big private banks are not performing.
Yeah, it's an interesting thought. And for everybody who's saying that private banks are screaming value, they've been value for a while now. Maybe what Manish is saying is are reasons which are keeping these stocks off. Manish, the other aspect is, and which has befuddled most investors, is what's happening with PSUs. It's unreal. I mean, we've seen cycles. This such seems to be, honestly, the cycle seems to be different from a price performance perspective. My question to you is it fundamentally different? Does it make sense to bet on some of these government-owned entities, or would you be skeptical?
So I think PSUs have gone from a broad-based undervalued basket to some froth coming through. But again, I think we should not paint all PSUs with the same brush. So we are definitely overweight on some PSUs where we think that with some a bet on reform happening or where the asset value of the PSU is much in excess of the market cap. Now, in general, across PSU, that gap between asset value and market cap, which used to be very big maybe 2 years back, is now zero, even negative in some cases. So for example, we are not in defense stocks because we think that the valuations are very, very stiff and there is no asset there. It's all earning based. Earnings are obviously more volatile than asset values. But if you look at some of the old economy sectors like refining or steel, I still think that some of the PSUs have asset value. Now, can that asset value translate into either earnings or value unlocking through divestment? Now, that's a probability-based bet you guys, every investor will have to take. And in that probability-based scenario, we still think some of these PSUs have value. But yeah, on a broad basis, it's becoming day by day very difficult to say PSUs have value actually.
And just before we wrap up the conversation, Manish, because we can't paint PSUs as a single bucket because there are different sectors. What within the businesses or sectors or themes, be it PSU or private, but predominantly I'm asking this from a perspective of a PSU, what themes look attractive where the PSUs have a dominant presence? I mean, there is OMCs, there is power, etc., etc. What looks attractive?
So one, from an earnings momentum, anything related to power is attractive, right? So whereas coal production or thermal plants and all that. The other way to look at it is if you see a PSU and say that if this were to be divested or run very, very efficiently, what would be the normalized earning or what would be the value can be sold for? So a lot of the PSUs we own are actually from the second basket. We also have the thermal power and the power basket, but there as I say, day by day, the gap between fair value and market cap is running out. But if you think about that, we've not seen a third-term government for long, so we don't know what kind of reform, what kind of actions can happen. But if you believe that some divestments can happen at strategic level, you'll have to think about when these PSUs are divested strategically, what can be the fair value. And in some cases, we feel it is a multiple of current market price, in which case it is good to have some bet. Now you can say that I will take 0.5% or 5% of portfolio. I think it's up to the judgment, but I do think there were some bets.
Wow, and that's an interesting call, viewers, because the FM in our conversation, in our interview as well, went out to say exactly the same thing, that divestment will not be a necessity. It will happen when there is fair value, and they are trying to make changes in the organizational structures as well to enable these PSUs to reach fair value sooner rather than later. Manish, fantastic talking to you today. Thanks so much for giving so many insights in one single conversation, and which means that we should try and have you more often than what we usually do. But lovely talking to you today.
Thanks for having me.
Now, the pleasure was ours. And viewers, thanks for tuning into this edition of The Talking Point.